a 75 pip range expansion, a complete annihilation of the daily moving averages. And yet, I am telling you right now, the euro is potentially building the biggest bull trap of the month. The screen is red, the sentiment is bearish, but the structure on the higher timeframes has not broken. There is one danger zone below us that, if breached, opens the floodgates, and one hidden opportunity above us that most traders will miss because they are too scared to buy. I'll show you both. Stay until the end. I'm giving out 3 exact activation levels and the specific stop losses that the algorithms are hunting. Let's cut through the noise. The session bias on the 4-hour chart is unidirectional, short. We are trending lower with momentum. But the macro bias on the weekly and monthly charts is still a deep buy-the-dip structure. This creates a conflict. Today's session is defined as a fading opportunity with a bullish structural lean. We are looking for the 4-hour waterfall to exhaust itself into the weekly support. Write this number down, 1.07739. That is the weekly moving average, and it acts as our structural invalidation level. If we close below 1.077 today, we are not looking at a dip anymore. We are looking at a macro trend reversal, and all buy plans are off the table. If we hold it, this is a liquidity grab. Let's verbally walk the charts from the top down, because this is where the narrative gets complex. Look at the monthly time frame. What do you see? We are not in a bear market. The long-term architecture is intact. We are trading at 1.08447. The monthly moving averages are miles below us. The MA5 is at 1.06751, and the MA10 is at 1.05441. This means the current crash is happening in the premium zone of the monthly range. This is a macro retracement inside an uptrend. It's violent, yes, but it is not a breakdown of the macro structure. Now, drop down to the weekly. Here is where the fight begins. We had a beautiful bullish sequence, but this week's candle is a massive red engulfing line that has sliced straight through the weekly MA5 at 1.08820. That's our first resistance now. We are falling hard, and the next magnet on the weekly chart is the MA10 at 1.07739. This is a critical deep support zone because the weekly MA40 sits lower at 1.04776, but the MA10 is the dynamic trend line for the intermediate uptrend. If buyers step in, they step in there. Now, let's get surgical. The daily chart is a massacre. We didn't just break down. We did it with conviction. We have a 75 pip candle that is cut like a hot knife through butter. We are below the daily MA5 at 1.09224 and the MA10 at 1.09152. But here is the killer. We crashed through the daily MA20 at 1.08901. That is the bread and butter moving average. The market closed below it. The MACD on the daily has fired a high momentum sell signal, a death cross right below the zero line with the histogram expanding. The air pressure is pointing to a continuation toward the daily MA40, which is sitting right at 1.07947. Notice how the daily MA40 and the weekly MA10 are converging almost perfectly in the 1.0770 to 1.0795 zone. That is a confluence of defenses. Finally, the execution timeframe, the 4-hour. This is ugly. It's a waterfall. We have not printed a single bullish consolidation. We are pinned below the 4-hour MA5 at 1.08588. The MA5 is your control line for the short-term trend, and we haven't even been able to touch it. The 4-hour MACD is in free fall below the zero axis. The histogram is red, and while we are technically oversold on some oscillators, there is zero bullish divergence. The momentum is purely downward. However, remember, the strongest rallies are born from these extreme 4-hour plunges when they hit the right support. Right now, 1.08800 is the old daily MA20 and the 4-hour MA10, a brick wall of resistance. A break above that is the first sign the sellers are losing their grip. Why did this happen? The core news is right in the headline. Rising yield pressure from the US dollar. The spread between German bonds and US treasuries is blowing out, and that capital flow is crushing the euro. This isn't a Eurozone disaster specifically, this is a dollar-dominant story. And we can see this confirmation when we look at the cross-asset linkages. As the dollar index rips higher, risk proxies are getting hammered. The Australian dollar, our China proxy and risk barometer, is likely taking heavy water too, confirming that this euro to US dollar drop is a broad USD rush, not an isolated ECB panic. But here is the structural pivot, the trap mentioned in the title. Look at the S&P 500 and Bitcoin. If the dollar is rallying this hard, the risk asset shadow should be collapsing. But if we start to see the S&P 500 hold its ground or even rally while the euro falls, we know the dollar strength is temporary or isolated to fixed income flows. More importantly, I'm watching the pound sterling to US dollar, the dollar killer. Is cable crashing with the same velocity? Or is the euro to pound sterling cross-holding? If the sterling holds better than the euro, the ECB policy differential is the weak link. If it crashes too, it's a pure global margin call in FX. That dictates if we buy the dip or sell the rip. My 2-week directional lean is a washout to 1.07739 followed by a violent short squeeze. The event that invalidates this is a daily close below 1.0750. If that happens, the monthly structure cracks. Most people will click away because they think the analysis is over, but this is where money is made. Keep watching. We have 2 precise plans. One to ride the momentum, and one to fade the extreme. Let's start with strategy 1, the sniper, conservative short. Given the daily death cross, we need to respect the bearish momentum until the last second. The sniper doesn't chase price. The sniper waits for the retest. The 4-hour MA10 and the broken daily MA20 converge at 1.08927 to 1.08901. That is the cry for help zone, trigger condition, a pullback rally into the resistance band of 1.08880 to 1.08920, accompanied by a rejection wick on the 15-minute chart. You are looking for price to poke into this zone, hesitate, and reverse. Stop loss. Place your stop above the structural swing high that broke the bearish structure. That is 1.09250. This is above the daily MA5 and the 4-hour MA40, giving the trade room to breathe and proving the trend has changed if it. Target 1. 1.08300. This is a return to the today's low area for a risk-reward of roughly 1 to 1.5. Target 2. 1.07950. This is the magnet of the daily MA40, for a risk-reward of almost 1 to 3. This setup is voided if we get a 1-hour candle closing above 1.09050 before triggering. Let's see how aligned we are. Type your euro to US dollar range for tomorrow in the comments now. Do you see the low holding? Or are we breaking below 1.077? I'm reading them. Strategy 2, the active trader, standard long. This is the high probability structural play. We are buying the washout. Entry condition. We wait for the dip to penetrate the 1.07950 handle, the daily MA40, and flush down into 1.07739, the weekly MA10. That spike zone is the trap. You don't buy with a market order into the free fall. You wait for a bottoming pattern on the 30-minute chart, a piercing line or a bullish engulfing candle that pops back above 1.07850. Stop loss. We are hiding below the weekly structure. The stop goes at 1.07580. A break below that confirms the trap failed, and we are going straight to 1.0700. Target 1. 1.08450. That's the current spot price zone, the breakdown origin, for a massive risk reward. Target 2. 1.08800. The ultimate retest of the breakdown level, old daily MA20, trailing stop rule. Once target 1 is hit, move the stop to break even immediately. We are not letting a winning structural trade turn red. Strategy 3, the aggressor, high risk. This is for traders who understand they might get stopped out instantly. This is the momentum short inside the 4-hour control line. Entry, a touch and hold below the 4-hour MA5, currently dynamic at 1.08588. As price tries to lift, if it slams into 1.08588 and crumbles, you enter on the 5-minute bearish engulfing. Stop loss, 1.08720. Extremely tight, just above the intraday rejection. Targets, 1.08000 zone. This is catching a falling knife with a scalpel. Only for those who know how to lose small and manage risk aggressively. If the market takes out 1.08720, the aggressor is dead, and the snipers and active traders take over. Never risk more than 1 to 2% of your account on these setups. This is a binary event zone with massive volatility. No positions through high-impact news if you haven't factored in slippage. Stops are non-negotiable. This is a market hunting for liquidity. Don't let it be yours. So we have a clear map out of the chaos. The world sees a crash. We see a buying opportunity within a crash. The critical level for the next session is 1.07739. That's the number. If we tag it and bounce, the weekly trend is salvaged. If we slice through it, the euro is in deep trouble. Tomorrow, we are focusing on the PCE data aftermath and whether the 200-day moving average on the dollar index holds, which will dictate if this euro drop accelerates. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily institutional grade coverage. I'll see you in the next one.